In the past 5 years, you may have heard the word market manipulation, whether that be from the recent meme coin rug pull shenanigans or the GameStop short squeeze back in 2021 by r/Wall Street Bets. While the term is common nowadays, being thrown around by politicians and your redneck uncle who is paranoid of the government alike, not everyone knows how market manipulation works. Some people talk with fear about how BlackRock controls the entire market simply because they own $11.5 trillion worth of assets when it's really not a big deal. In this video, you will be given an in-depth guide on how market manipulation truly works, provided with examples, and how you as an individual can protect yourself from such dangerous acts. When you hear the word market manipulation, what do you imagine in your head? The boogeyman George Soros controlling you like a marionette, each tug of the string draining your investment account? Or a hacker going in the system and changing stock prices to make your investments worthless? In reality, like everything in this world, it's much simpler than that. Market manipulation is an act that involves in artificially influencing the price, supply, or demand of a financial security. In short, market manipulation isn't technically violating any rules, but rather, it is the abuse of rules made possible by the system within the market. For example, in my previous video, which explains all known market manipulation tactics, I've talked about the pump and dump scheme where an individual or organization buys a ton of the same assets to drive up price before selling for profit and leaving other hopeful investors in the dust. There is no rule in trading that prevents you from committing this scheme, and you technically could commit it given you have enough capital and are ready to face the consequences. So in reality, market manipulation is not some complex scheme or hack into the system, but rather a simple theft or robbery in a different environment. With the mystery of what market manipulation is uncovered, we ask the question, who are the manipulators? Is it the politicians in Congress who are somehow earning more than their salary? Is it the president of Argentina who launched his not-so-obvious meme coin, which he totally wasn't going to rug pull? If you want a concrete answer, I've got bad news. Anyone can be a manipulator as long as they have the intention. But if you're really that nervous, I've made a list of the most common culprits. Firstly, there are the hedge funds and institutional investors such as Citadel and Renaissance Group. The largest organizations have the necessary capital and influence to influence the market to move through large trading volumes or spreading rumors. Secondly, there are corporations and corporate executives. Corporations might manipulate the market by selectively releasing information to move its stock price in favor, while corporate executives have access to non-public information that they can use to trade the markets. Thirdly are the government and central banks. They can manipulate the markets through money and fiscal policy such as printing money and setting interest rates. Lastly, there are the social media influencers and online communities. In today's world, social media is a powerful tool. Platforms like Twitter, Reddit, and even TikTok are used by millions to spread information, influence trends, and of course, manipulate markets. A perfect example of this came in 2021 with the GameStop short squeeze. A group of retail investors from the Reddit community, r/Wall Street Bets, noticed that hedge funds had shortened GameStop stock to an extreme degree. They organized and began buying shares, causing the price to soar as short positions began to get squeezed. This unexpected surge in price forced hedge funds to buy back shares at a loss, causing them to incur billions of dollars in losses. While this was a retail-driven event, it showed how information, rumors, and collective actions through social media could manipulate the price of stocks. Now that we looked at who the manipulators are, let's talk about the consequences of market manipulation. The effects of market manipulation can be far-reaching, not only harming individual investors, but also eroding public trust in financial markets. When market manipulation takes place, it distorts the natural function of the market, leading to the mispricing of assets. If the true value of the stock or asset is not reflected in its price, investors might make poor decisions based on inaccurate information. For example, if an investor believes a stock is undervalued based on manipulated information, they might buy in only to see the price drop once the manipulation ends. On the flip side, overinflated prices can encourage investors to buy into bubbles that eventually burst, leading to widespread financial loss. Another consequence is market volatility. Market manipulation can cause dramatic and unpredictable swings in asset prices, which increases the risks for everyone in the market, including day traders and long-term investors. Flash crashes, sudden and severe market drops that occur within minutes, often have manipulation at their core. A well-known example occurred in May 2010 when the Dow Jones Industrial Average dropped nearly 1,000 points in just minutes due to algorithmic trading and potential manipulation, though it later recovered. Such volatility erodes confidence in the stability of the markets and can lead to higher costs for investors who must navigate through these turbulent waters. Additionally, market manipulation can contribute to market inefficiencies where prices do not reflect the actual value of assets. This can result in capital misallocation where resources are not allocated to the most productive uses. For instance, if an overvalued stock is manipulated into a bubble, it can divert attention and capital away from more solid investments, potentially hindering overall economic growth. Now, if market manipulation is so problematic, how are regulations trying to prevent it? Well, there are several laws and regulatory bodies in place designed to curb manipulative behavior. In the United States, the Securities and Exchange Commission, SEC, is the primary body tasked with enforcing regulations against market manipulation. The SEC has a variety of rules such as the Securities Exchange Act of 1934, which makes it illegal to manipulate the price of stocks through fraudulent or deceptive means, One key law under the Act is the Rule 10b-5, which prohibits fraud in connection with the purchase or sale of securities. The SEC also monitors insider trading, which is another form of market manipulation where individuals use non-public information to gain unfair advantage in the market. Another significant regulatory framework is the Commodities Futures Trading Commission, or CFTC, which regulates markets for commodities and derivatives. The CFTC aims to ensure fair and transparent markets and prevent manipulation, particularly in areas like futures contracts and commodities trading. While these regulatory bodies exist, enforcement can often be difficult. The complexity and rapid pace of financial markets make it difficult to detect manipulation in real time. For example, high-frequency trading, HFT, algorithms that execute thousands of trades in fractions of a second can sometimes engage in manipulative practices without being immediately noticed. Even if the SEC does catch fraudulent activity, the process of taking legal action can be slow, and the penalties may not always act as a deterrent. Another issue with market regulation is that cryptocurrencies and decentralized finance, or DeFi, often operate outside traditional regulatory frameworks. In the world of cryptocurrencies, manipulation is rampant, and regulatory bodies like the SEC have struggled to keep pace with the fast-evolving technology. While the crypto market has garnered much attention from regulators, global efforts to curb manipulation in that space is still developing. Given that regulations aren't perfect, how can individuals protect themselves from market manipulation? There are several strategies you can take to safeguard your investments and ensure you are not caught in the crossfire of manipulative tactics. First, education is key. Understanding how markets work, especially how prices are determined and how different types of orders and trades can impact price movements. If you are a long-term investor, it's essential to focus on fundamentals and not be swayed by short-term volatility caused by manipulation. Know the difference between speculative hype and companies with strong earning potentials. Always do your own research and make decisions based on solid analysis rather than rumors or hearsay. Second, diversification is another effective strategy. By spreading your investments across different asset classes, such as stocks, bonds, real estate, and commodities, you can reduce the risk of losing everything if one particular market is manipulated. Diversification ensures that you are not overly exposed to the whims of any one market or sector. Third, stay informed about the news and developments in the markets you invest in. Often, manipulation is preceded by certain warning signs such as sudden surges in social media activity or strange price movements. For example, if you notice a cryptocurrency coin being heavily hyped by influencers on Twitter or Reddit, it might be a sign of a pump and dump scheme in the works. While not all hype is manipulative, being vigilant can help you spot red flags early. Lastly, if you're unsure or do not have the time to follow market developments, consider using a financial advisor. Advisors who are well versed in the market's complexities can help guide you through potential risk and make more informed decisions on your behalf. Just be sure to choose a fiduciary advisor who is legally obligated to act in your best interest.